Canadian industrials are caught in the eye of the tariff storm. As trade tensions ripple through global supply chains, some sub-industries are finding unexpected opportunities in the reshuffling. What are some of the potential tariff off-ramps, for instance, and how could they act as a positive catalyst for markets in the months ahead? Joining us here today for a deep dive into forces driving Canadian industrials, the sector itself, is equity research analyst Bobby Reynolds. Bobby, great to see you. Welcome.
Thanks for having me, Pamela.
Yeah, great to have you back joining us. Let's kind of spread it out to a macro story, put industrials in it, which, I mean, they're pretty foundational within it. But there's discussion about the consumer, about whether a recession is coming. These are the circling conversations. Where does industrial sort of fit within that? There are defensive plays there, but not all of them.
Yeah, so Canadian industrial is a very diversified sector. You've got more cyclical companies like railroads, transportation stocks, capital goods, airlines. And then on the more defensive side, you've got companies like waste or garbage companies, information services, the engineering firms, which have more defensive earnings. And so there's both ways to play it. Just to your question on how we're looking at the market, things are changing constantly. Our job is to be on top of how does what's been proposed impact earnings, both from a first order perspective, but also we need to think about the second derivative of what did these policies mean for economic growth, what could they mean for trade flows, and maybe where are some companies that could actually benefit out of this, because on some days there's just been a broad market sell-off and we want to have our shopping list of companies that we like and could come out of this stronger on the other side.
Let's turn a little bit with some of the economic data that we've gotten. So sentiment came out this morning, this is U-ish, so it's US. But also we got CPI in the US, which looked actually okay, but there were some readings on, for instance, the airlines. Why don't you take us through some of the pieces of data that are coming through that are backward looking, but maybe are pointing to something?
Yeah, so the sentiment surveys in both Canada and the US have been very weak since effectively late January, when the tariff threats became more real to the market. And that's already hitting some of the hard numbers for companies. You mentioned airlines. We had Delta earlier this week effectively pull its guidance for the year because of uncertainty of what future bookings look like. Air Canada noted at their general meeting that bookings to the US were down about 10% for through the peak travel period this summer. And so some of the more discretionary spend is already getting hit. In contrast, in autos, there's actually a very strong month for auto sales in March. That's likely due to pull forward ahead of potentially higher prices due to tariffs. And so we're tracking all of this to understand how it will impact companies that we could invest in or are invested in. And we're also trying to look at where could things change down the road. One example is you haven't seen a big volume hit to railroads yet, but what does that look like in the next few months as tariffs potentially create a weaker demand environment?
A weaker demand environment. Let's go into rails for a second. I mean, they've had a very interesting time kind of since COVID. I guess every industry has, but in terms of inventory and demand, and there was a big supply question, wasn't it, at that point? Which area of the cycle are rails sort of sitting with right now?
So there's been a broader freight recession in North America since 2022. And you have to understand you're coming off the biggest upcycle for freight in the last few decades in 2020 and 2021. And what happened in 21 is every company overordered inventory, and in 22, and that created a big destocking cycle in 23 for the freight companies. Since then, it's really just been anemic economic growth hasn't been enough, and there's been an oversupply of truck capacity in the market, which the rails do compete with for certain types of freight. And that's created a sort of a weak earnings growth environment for the Canadian rails. You've also had labor issues in Canada over the last 2 years, and natural disasters, which have created operational disruptions. And so coming into this year, there was actually a more optimistic potential story for the rails because you had interest rates falling.
Right.
You saw some of the leading indicators for the industrial economy improving, such as the PMI new orders, which got above 50 in late 24 and early 25. but tariffs have sort of wiped out that optimism about an economic recovery. And now, the rails have easy comps, but is the broader economy going to be supportive of positive volumes and enough for them to meet sort of the earnings growth expectations that the market has for them? I think that's the key question that people are wrestling with right now.
So are there opportunities within Canada to offset some of the demand? This is what everyone's sort of trying to look at. Let's go into the auto story. We know a lot of the headline pieces that are there, and the dates, and the part makers as well. What are you hearing? Fidelity is often very much in touch with the CEOs or the industry leaders. What are you hearing from the auto sector at this point that maybe we haven't heard?
Yeah, so just to back it up on our research process, a big piece of that is meeting management teams, traveling to visit companies at their operations. And so I have met both Canadian auto suppliers over the last week. I was meeting engineering firms in Canada and the US in the last couple of weeks. And I was in Vancouver 2 weeks ago to meet the railroads in Vancouver, which is the biggest Canadian port. And so we try to stay in touch with our companies, boots on the ground. And as it pertains to the automakers, so far there actually hasn't been a big change in customer order patterns from the OEMs. You have seen the headlines about Stellantis shutting down some production in Canada and Mexico, but broadly, no big impact. The industry is really worried about the parts tariffs, though, the 25% parts tariffs that take effect May 3rd, and think that could be a bigger catalyst for more plant shutdowns. And the reality is the US only produces 8 million vehicles. They've got demand for 16, and so they need to import from elsewhere. But even those 8 million vehicles, you could see some of that shut down because a lot of the parts are coming from Canada and Mexico, and they don't think the consumer can necessarily take the impact. And so right now, what's the off-ramp is the question for the industry. I think what the administration would like to see is higher capital commitments in the US, but the industry has just come through a 4-year cycle where they invested billions in electric vehicle plants.
This is in Canada,
and in the US. Because of the incentives that the Biden administration put in. Now you have the Trump administration talking about removing those EV incentives, but saying you need to invest more in US plants because of the carrot stick. And really the only return on that investment is tariff avoidance, because you're doing it in Mexico or Canada because it's cheaper than in the US. And so the industry is in a very tough spot. And I think they're hoping that the administration relents without needing to sink a lot of money into the ground.
So let's just sort of break that down. So if Canadian parts makers were going to go and invest more in the US, what are they contending with right now? What are the pieces that would lead them to that or not?
So if you're a Canadian parts maker, you're typically locked into an automotive program for the life of that program, which is 5 to 7 years. Your OEM could say, hey, our next iteration, we're going to source it from the US.
Our next minivan
our next model will be made, or will only source US parts. That's typically a multi-year process to then set up the production capacity. It's a just-in-time inventory supply chain, and so you need to be close to where the assembly plant is. Geographically close. And by the time all of that happens, you're probably near the end of this presidential term. And so to just say you're going to move capacity in the near term for that industry, it's just not feasible for them. But I think the administration does want some big headlines that they can point to as wins. It's probably more likely amongst the Japanese and Korean OEMs that are importing finished vehicles to see more of these announcements. We saw Hyundai in March announce a large new facility in the Southeast US, as well as building a new steel plant. That's the moves that I think you could make sense of more structurally versus trying to get a parts plant from Canada or Mexico to move into the United States.
Is the auto industry waiting for NAFTA to be renegotiated? I mean, is that sort of...
That's one of the potential off-ramps. And if you look at how the initial USMCA, which Trump signed, was written, there is no requirement for US content in the USMCA. There's a requirement for North American made content. It has to be 75% of the value of the good to be USMCA compliant. But there's no specific US content requirement. So one of the obvious negotiating pieces will be, hey, we will put a minimum US content requirement into the new USMCA negotiation to appease the administration. And there's already such a high percentage of US content that you could put a number in there that will look good from Trump's perspective, but might not be overly onerous for the industry to meet. And that's one of the hopes of these automotive executives is, you provide some what look like concessions that are actually relatively achievable at low cost.
Okay.
That's more of the optimistic scenario of how this could play out.
And is there, when you look at companies like waste companies, those are very defensive, right? I mean, those aren't going to budge too much.
Waste stocks have been relative outperformers this year and in 24, at least relative to the Canadian market. Some of the positive attributes for them are strong pricing power because
inelastic. You need to have your
relatively inelastic demand. If you're a business and you go out of business, you're not going to need that garbage service anymore. But if your business and your same store sales are down 10%, the garbage bill is the same because they're not charging you based on the weight of your trash. They're just charging you to come and pick it up and take it away.
Yep.
And so it's a relatively inelastic demand. It's a price-driven industry, so the volumes don't grow, but pricing for the industry has been up between 5% and 9% a year for the last 3 years. It's a very local service, so there's no real tariff issues. I mean, they have to buy trucks, so you could see some inflationary pressure on their CapEx, but relatively small, and they'll price for that. And so it's still a fragmented industry with an opportunity for the larger players to consolidate it. And as it's consolidated, the pricing power is improved. And so there's a lot of attractive attributes, not gone unnoticed by the market. These are high multiple businesses, but it's high multiple for a reason. They can generate positive free cash flow and earnings revisions, and you don't really have to worry about the tariff implications on the business.
So it is an area for those looking for a place to hide within equity markets. This would be on balance a place to take a look.
Yeah, this would be one of them. I think the other thing worth mentioning is Trump is progressing his tax bill. I believe it made a vote through Congress in the past week.
Yeah.
And so that's something the market's not really paying attention to now. But there's a lot of goodies in there for businesses that could drive positive revisions to earnings and free cash flow. One example is the accelerated depreciation, which Trump introduced in his first term. Allows you, if you buy a piece of capital equipment, you can write it off in 1 year instead of 5. And this is very beneficial to companies like the waste businesses that buy a lot of capital equipment in the US. And so it's things like that could actually drive some positive movement in consensus numbers relative to other companies where you're just worried about the economy and will earnings even be there in the next year.
Worried about the economy often allows for conversations about stimulus. The US may be looking at that a bit differently right now because fiscal stimulus seems to be absolutely not what they want to be going to. In Canada, though, for infrastructure, there's conversations that there's room to spend, at least. Tell us about the infrastructure businesses, the engineers.
Yes.
We're talking about lots of big projects. Who knows if any of them will get built, but the discussion is there.
So the Canadian engineering firms have been great stock market performers, great companies over the last decade plus. These are consulting firms, effectively, with good margins.
Low overhead.
Well, they're people-based businesses, right? And they've done a good job consolidating the industry over time. There's actually one of the examples of an industry where you can say Canada has global leaders. And if you look at the infrastructure environment over the last 4 years coming out of the pandemic, very strong tailwinds. You've had the US pass the IIJA in 2021, and that's the Infrastructure and Jobs Act.
Gotcha, okay.
And that's runs through 2026. But the interesting thing is they've only spent 35% of the money that was allocated in that bill.
This is part of the IRA, is it?
The IRA is separate. That was the Inflation Reduction Act, also a tailwind. although less important for the engineering firms that are more focused on infrastructure versus just building facilities or advising on that. In Europe, you've had infrastructure stimulus as well, both post-COVID, but now more recently with Germany talking about a $500 billion infrastructure plan to go along with potentially a $500 billion defense plan. Same in the UK. In the Middle East, there's been an infrastructure boom. In Saudi Arabia, as they try to diversify away from oil. And then if you bring it back to Canada, the governments here have been very pro-infrastructure. It's partly been to deal with the population growth that we've had over the last 4 years. But now we're talking about it as a way to support the economy if demand from the US is weaker. And you also look at it from a defense spending perspective. If you want to spend more on defense assets, there's a lot of infrastructure that goes around that. So we're buying F-35s. They're going to have to build new air bases and hangars to support those planes. And so there's a lot of different areas where these companies can see tailwinds, and it's a longer cycle business. And so they've got backlogs, less reliant on near-term fluctuations in consumer demand. And they've had very strong relative earnings growth as a result of all these. You'd also say on the AI theme that it's a sector that both from building data centers, but also from using AI. It's a white collar profession, but it's not a commoditized profession. You're still going to need an engineer to sign off on a bridge, for example. So it's potentially one where you could see more of the margin benefit stay with the business rather than get competed away because AI brings the cost down.
That's fascinating. That's so interesting. If we circle back to airlines, you mentioned one of the big US ones, but also within the domestic market, I mean, we do have some players. Is there an ability, again, to sort of grow what's domestic? We're cutting flights apparently to the US.
So airlines the stocks tend to live and die by the direction of pricing.
Right.
And if you see the airline stocks in the second half of 2024 were great performers. And the reason for that was airline pricing started to find a lot of momentum because there was capacity reductions in both the US and the Canadian market, or a slowdown in capacity growth, which allowed demand to outstrip that capacity. And it's a sort of a commoditized service in many ways. What's happened since then is obviously consumer confidence has fallen off, but also there had been more capacity growth coming back into the system in both Canada and the US. As a result of the weaker cross-border demand, airlines are trying to rejig their routes, both for more domestic flying, but also more European flying or flights to Asia. One area where the Canadian airlines might be able to pick up some business is the European traveler who was going to go to the US might decide to come to Niagara Falls or Banff National Park instead.
Yeah,
right?
I was going to say, are more likely some of our other beautiful natural areas.
Exactly.
Yeah.
So there might be some offsets, and price of jet fuel's fallen a lot as well. So sentiment's very weak on the airlines right now, sort of for some good reasons, but we have to watch when stocks get really beaten up, just what's embedded in the price, and we'll see what happens with the airlines.
Okay, more to say on that. Does the Trump tax bill extend the existing level of corporate taxes? Well, we know it's trying to do that for sure, or reduce it compared to his original cuts in the first term, right?
So just to clarify what's been passed so far, it's really just being a framework, which with no details in it. So it's a framework saying we'll allow this much tax cuts relative to the baseline in exchange for this much in spending cuts. It doesn't specifically say what the tax cuts could be, where the spending cuts would come from. And so all of those details still need to get ironed out. Trump said a lot of different things on where he'd like to take the corporate tax rate on the campaign trail. It's 21% right now. He talked about maybe bringing it to 15%. Then he talked about 20% is a nice round number, and it's maybe more realistic. I think most people's, the market's expectation is it's going to remain around that 21% numbers. It's more the other tax changes that could be more impactful, again, like the bonus depreciation, research and development write-offs, maybe auto loan interest deductibility, which would help the
car
makers making car purchases more affordable.
Are any of those particular details enough to make Canadian companies that you're talking to their leadership move? A better corporate tax environment? I mean, we do have high taxes here.
I think that the certainty provided by a bill can spur more investment in the US. You need that certainty. You also need trade certainty, because that's a big issue. The biggest issue right now is you don't know what the rules of the game are, but it's one of the catalysts that you could see over the next 6 months that could help the market find its footing.
But would it see Canadian companies potentially setting up shop there, or just maybe extending their investment? Is what
extending the investment is more the case. I don't think this tax bill on its own changes the rules of the game enough for the Canadian businesses that I follow to make a wholesale shift. Now, there are many companies that I talk to that are looking to move production to the US to avoid the tariffs. Generally not in the automotive sector, though.
Okay, which
generally
ones?
More in the smaller, more niche manufacturing sectors, or maybe in distribution, where you can set up a facility for, in the low tens of millions of dollars in the US, rather than in auto parts where you might have to make a $500 million or $1 billion investment for the scale of what that industry produces.
Bobby, what do you think about the capital expenditures you talked about for automakers, for EVs particularly here? There's been great discussion about China moving all kinds of parts into Mexico, and we know that the Trump administration would like to avoid EV manufacturing coming into this market here. Does Ontario, does Canada have a chance at sort of taking that over and becoming what some of the Chinese imports to Mexico was or are?
So in the past 3 years, you have seen big announcements for EV facilities in Canada, supported by large government incentive programs in Ontario and in Quebec.
It is actually mostly built.
It has not been built yet. It's broken ground. One example you have is Volkswagen. Doesn't have production in Canada currently, but announced one of their largest battery plants in the world near London, Ontario. That's broken ground. I think there's an open question right now in the industry is, do they finish building that facility, or do they pause the investment? Because the reality is demand for EVs in the North American market has not been high enough to justify the investment case for most of these plants.
Right.
And now we're talking about incentives going away. And the reality is in China, they have a huge domestic market, and they brought the cost of their EVs down tremendously using the advantage of that scale and government sort of incentives and stimulus and subsidies. So the only way North America can really compete with the Chinese EV is through trade barriers in this specific case.
Okay, so it's not that there'll be a niche for sort of our Canadian side of things necessarily in a new NAFTA. I mean, certainly that's going to be broached, but whether it goes anywhere, I guess.
Yeah, I think that Canada will likely be able to win a share of what happens in North America, but to talk about it being a major export hub for production of EVs, I think that's a bigger stretch, considering we're not really a major export hub for vehicles outside of North America. What we produce here tends to be sold in the United States or Canada.
Given the market action this week, which needs another word other than action because it's been massive, what are some of the off-ramps here to de-escalate the overall tone of everything and the temperature ultimately to bring it down?
Well, I think what we saw on Wednesday, and Trump said it was the bond market going haywire that
it provided him an off-ramp.
So
perhaps?
Some of the corporates that we speak to, I think, are hoping Trump realizes it's bad policy on his own without needing them to offer major concessions that would cause like uneconomic capital expenditure if you're the auto industry over the next few years. I think that's the hope.
Okay.
So it's almost a game of seeing enough market pain to see where does the Trump put sit per se.
Right.
So that's one of the off ramps, the market reaction function. There's also the USMCA renegotiation, as we discussed earlier. specific for Canada and Mexico, where I think you could realistically see them getting to some sort of agreement that's palatable for all. The China-US situation is the most difficult because they're geopolitical rivals. It's gotten to the point now where you just see like a stop in flow of goods in a number of industry between those two countries. So that will cause real economic pain to the extent it's drawn out. And so I think that's why the market initially was very excited about what happened Wednesday, but then came to the realization of how bad the situation is with China and that we need to see that de-escalate.
So are we at a point where some of the across the industrials complex are looking for new markets? You mentioned autos. We talked a bit about even airlines and airline builders looking to Europe, but let's just sort of discuss the opportunities for new markets. Is this a moment that what are company leaders saying? Are they actively seeking new markets right now?
Depends on the industry. Some certainly are. If you think about Canada being a large export-oriented, commodity-producing country, this is very relevant for the railroads because you've got maybe some concern about grain going to China if Canada is in the camp with the US and sort of putting up tariff barriers on China. China's already put a large tariff on Canadian canola. So there is a need to find new global markets for commodities. Given it's the commodity product, that tends to be easier to do versus if you're an automotive parts manufacturer where you need to be located close to your OEM customer. That's a much more difficult discussion. There's been lots of talk about building new pipelines in Canada. If that comes to fruition, there's lots of industrial businesses across the engineering space, across the equipment space that would benefit from that economic activity. So it's definitely something that I'm paying attention to, but it's mostly centered realistically around what can we do in the resources space to get our natural resources to market more quickly, to fast track project approvals, and then what are the businesses that if we can actually do that could benefit.
Right. Okay. So is it a moment, final question, is it a moment to dip the toe in, or is there just too much uncertainty? I think a lot of people are looking at prices right now, which have come down massively. Is it a moment to dip the toe in?
I mean, from a bottoms up perspective, we are finding lots of opportunities in the current market. In some cases, you need to take a longer term perspective. Nobody knows what's going to happen, in Q2 and Q3 this year with how the tariff situation plays out. We've had recessions in the past. If you're a well-run business with a good balance sheet and a good management team, sometimes you can turn those into opportunities. You can acquire weaker competitors, or you can invest to take market share through a downturn. So we look for those opportunities in the more cyclical businesses. And then there are some just good thematic stories that we think can probably power through with good earnings growth through this period. They might trade at higher valuations, but the stability and potential positive upside to earnings would justify those valuations. So we definitely think there's opportunities on both sides of the spectrum.
Okay, how are Canadian steel and aluminum companies weathering the tariffs so far that you were just mentioning, sort of the resources sector broadly and the inputs ultimately there? But yeah, what do you think?
So the steel companies are actually covered by my colleague, Claire Fleming. I do cover a steel distributor. So far, the volume impact hasn't been huge. This was as of 2 weeks ago. Right. So maybe things have changed at this point. I think that the automakers haven't massively curtailed production is a big deal for volumes not falling off. And if you look at steel prices, they're actually at very elevated levels right now because of the tariff. So to the extent volumes don't fall off, these companies will actually see very high profitability. It's just a question of what do things look like in 3 or 6 months. If the tariff situation broadly doesn't improve and we go into a recession, then there could be a lot of downside to those commodity prices. But right now, the earnings picture is actually quite positive. I know there's been anecdotes of the smaller, maybe non-public companies or steel or aluminum, forgers or people that would export smaller products to the US facing pressure. But generally in the public company space, haven't seen a lot of pain there at this point.
Okay, so it's a question for maybe a few months down the road. Bobby Reynolds, thank you for joining us and helping us get a picture of the sectors that you follow.
Thanks, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.